Hey there everybody, this is the last lesson for 40S Essential Math. We're going to put lessons 8 and 9 together from your vehicle finance booklet. So we're going to start with leasing a vehicle. And there are of course two ways that you can pay to finance a vehicle. You can either buy it or you can lease it. And there's some terminology here that we should go through. First of all, the lease term is the fixed, that means it doesn't change, non-cancelable period for which a lease agreement is in force. If you are going to lease, which means basically rent, for those of you who aren't sure, maybe the word leasing is a new word to you. If you are going to rent or lease a vehicle, you sign a contract that agrees to a period of time that you will pay and make lease payments, and usually there is no way out of that. That is non-cancelable. You can't just go back and take it back and say, I don't want this vehicle anymore, without paying a huge penalty. The lease payment is the regular payment made to the dealership. It's typically monthly, and yes, it does include GST and PST. You have to pay both taxes on your lease payments. The residual value, here's where I got to start writing. The residual value is the value of the vehicle at the end of the lease. It's sometimes also known as, if you didn't know what AK means, that means also known as the buyout price. And it's determined by the dealership. It's not like used vehicles where the price of an older used vehicle is determined by the book value. Actually, the dealerships can ignore the book value and set the residual or the buyout price of a vehicle that they're about to lease at whatever they like. So it's determined by the dealership when the lease is signed. So if you're about to lease a vehicle for 3 years, rent a vehicle for 3 years, you actually know before you sign the contract how much that vehicle would be worth to buy out at the end of the lease. Let me finish my sentence before I start talking again. I like talking so much I sometimes forget to write. There we go. So, for example, so if I go in to lease a new vehicle, I walk into the lot and I say, you know what, I don't want to buy a vehicle right now, I want to lease it. If I lease a vehicle for, say, 2 years or 3 years, it will have, right on the contract that I signed, a buyout price or a residual value price at the end. So if I enjoyed that vehicle and I want to keep it, I can choose to buy it out at the end of my 2-year lease. Okay, so the residual value rate is the rate at which the vehicle holds its value. Let me just put a little line here so we don't get these mixed up. Over the term of the lease. Okay. And finally, just like renting an apartment, you pay a security deposit on a leased vehicle. So it is the amount. Oh, I'm sorry, this one's got a definition for us. It's the refundable amount if there aren't any damages to the vehicle when it's returned. And it is usually, I'm going to say it's an amount that's approximately equal to, are you used to that symbol? That means approximately equal to 1 month's payment, rounded usually to the nearest $50. So if you were paying, say, for example, so if your monthly payments were $380 a month, would likely have a security deposit of So the nearest $50 to that would be $400. Right? So something like that. Okay, now, why would anyone lease a vehicle? Okay, well, there's pros and cons to everything. One advantage, I think the biggest advantage to leasing, and the reason why so many business people do it, is that at the end of 2 years, you can just, well, your lease is done, you take it back to the dealership and say, there you go, I'm done with it, and then you can just keep on going, and for the same likely monthly payment that you're making now, you can get a new one. So you can basically drive a new car every, generally 2 to 4 years is what leases tend to last. Now, you're never actually paying to own anything, so you're never going to get any equity. So the advantages of leasing is you get to drive a new car every 2 to 4 years, but the disadvantage is, of course, that you gain no equity in your payments. Now, we talked about depreciation payments. We talked about depreciation in the last lesson, and yeah, new cars lose their value, and you are paying for that in your leasing price, your monthly lease payments. One of the things that you basically are paying for is the fact that after you're done leasing it, they can't sell the car for as much as it's worth to sell right now. But on the other hand, you're not really out of pocket for that amount of depreciation because you're not stuck with that vehicle. So, like I was saying, business people tend to really like to lease vehicles because, well, there's actually 2 reasons for that. And one of them is, I'll put it as the next leasing advantage. Business owners can claim lease payments as a business expense for tax purposes. Now, this is something that you should probably talk to an accountant about if you are a business owner, just to make sure that you're doing this on the up and up and you're following the rules and the legalities. But basically, for the most part, if you buy a vehicle, you're not allowed to claim it for income tax and for business tax purposes the same way you are if you're paying to lease a vehicle. It's really complicated why the government works that way when it comes to collecting taxes, but it has to do with the fact that, say I owned a business and I just decided, okay, fine, I'll just use my business to buy a whole bunch of cars and then claim bankruptcy, say, oh, I'm bankrupt, and then, the bank then has to try to get all of the money back that your business might have borrowed from it. And remember that cars, when you buy them, have already lost their value to a certain amount because of depreciation. Whereas if it's a leased vehicle, well, that depreciation was already built in to the payments you were making when you paid for a lease anyway. So that's why that's a really simplified explanation. But that's basically why it's something that you can do as a business owner to have your lease payments for your vehicle give you basically a tax break, what they usually call a write-off, which means that that's a certain amount of tax that you don't have to pay equal to the amount that you're paying on those leases for vehicles. The other reason I think that businesses and business owners like to lease vehicles is, again, back to this whole, they want to be able to drive a new looking car every couple of years without having to worry about selling the old one and dealing with the depreciation. Especially if you're in the kind of business where, say you're in sales, say that your job is to convince other people to spend their money with you. Say that you're a financial advisor or you're a lawyer, you're an accountant. You kind of, to a certain extent, always have to dress nice. You have to wear nice clothes. And if you pulled up to a business meeting with your clients driving an old beater, you are not going to look like you are successful. You have to create the air that you look successful. And one of the ways that you can do that is by driving a new looking vehicle. So I think that's actually a very important leasing advantage, is that every couple of years you just trade in when the lease is up and get another new one. You don't have to worry about selling the old one. That, by the way, I could also put as an advantage. You are never stuck with a vehicle that might be hard to sell. So that's definitely an advantage. Some of the disadvantages now, well, one of them is, again, you have no equity. You pay less interest. Interest. Sorry, I almost misspelled interest. You pay less interest over the life of the vehicle if you buy to own rather than lease. Of course, eventually, you'll have no more payments, right? Eventually, you will own it. Right? Eventually, if you make enough payments on a vehicle, eventually you won't have payments anymore, whether it's a 3-year loan or a 5-year loan. Eventually, you'll pay the vehicle off and own it. Now, this question often got asked on the provincial exam. They would say, what is a disadvantage and an advantage of leasing a vehicle? And very often, one of the advantages, or they might ask the question differently, what's an advantage of buying versus leasing? And very often students would just say, well, if you buy the vehicle, you own it. And we were always told when we marked the exam that that was not good enough for a mark. And the argument was basically, just because you own something is not necessarily an advantage. It's an advantage if you have equity in it, if you own something that's worth money, that has value. But what if you own a vehicle that would cost thousands of dollars in repairs to get safety to be put on the road? What if you own a vehicle that's highly unreliable and breaks down all the time? Just because you own something doesn't mean it's necessarily a good thing. I think the example, the analogy that they used is, well, I own my dog, but what if he bites people? Just because you own something doesn't mean it's good. It has to be good for a reason, and this is the reason. When you own your vehicle, if you have a vehicle that's worth something, you have equity, and you can use that equity as to secure another loan or for just to build your equity. Okay. One of the disadvantages to leasing is you can have restrictions on kilometers and places driven. In other words, if you are renting a vehicle and you decide you want to take some long trips and drive to Florida and back, you will likely go over the number of kilometers that your contract says that you're allowed to drive it. Remember, it's not your vehicle. You don't own it. You're just renting it. It's a little like renting an apartment. You're not allowed to tear down walls and paint them funky colors and stuff because you don't technically own that piece of the building. You are renting it. And the same is true with a car. You're renting it. You can't rack up the kilometers. It'll say in your contract how many kilometers it has to be under when you return it. And if you're over that, you will pay quite a bit in penalties on that. Also, say you want to take your vehicle off to camping somewhere and there's gravel roads. There is such a thing as leases that actually specifically say don't drive this vehicle on gravel roads. So things like that, because you don't actually own the vehicle, you don't get to choose how far and necessarily where you can drive it. So that's a disadvantage. One advantage, though, is you are not responsible for repairs. I should say for some repairs not covered by warranty. this would be spelled out in the contract. Oh, I'm sorry, I'm off the screen. This would be spelled out in the contract you sign when you lease. When I buy a brand new car, after a year, it's going to need new air filters, it's going to need an oil change, it might need new windshield wiper blades. Those are wear and tear, and I'm responsible for those if I lease a car too. But what if something mechanical goes wrong with the car that isn't covered in my general warranty? Right? Now, most new cars, bumper to bumper, everything's covered in the warranty for up to 2 years. But you can lease up to 4 years. What if I had a 3-year-old vehicle that the, I don't know, the rear camera stopped working? That might not be something that's covered in the warranty of the vehicle because it was new from the factory. But remember, if I'm just leasing, I don't own it. It's not my responsibility to fix something like that. So that would be the responsibility of the dealership that leased it to you. So that's just an example. Some repairs. Which things would be covered and not covered after the warranty doesn't cover them would depend on the agreement that you make when you sign a leasing agreement. So that's the basic terminology and the basic ideas behind leasing. Let's get to some calculations, shall we? All right, so the first one is, the following describes a new SUV in Steinbach, Manitoba. The cost of the vehicle is $34,000 plus taxes, and they're including freight in the price. If you're not sure what that means, go back to the previous lessons. We talked about freight and closing costs and stuff. The monthly lease payment is $349 plus taxes for a lease term of 36 months. So you pay it once a month for 3 years. That would be 36 months. For leasing, a down payment is required. Very often there are down payments required when you lease. As well, a refundable security deposit of $500, and the first month's payment must be made when the lease is signed. The residual value is 75% after 3 years. Okay, so we're going to answer a bunch of questions about this situation. So for A, calculate the total monthly lease payment including taxes. Okay, so it's $349. You pay PST and GST, which is 12%. So I want 112% of $349, which is 1.12 times 349. Boom, $390.88. Okay. Next, calculate the total lease payment. Okay, well, I am paying this every month for 36 payments. So $390.88 over the lease term, which is 36 months. So I already have that number on my screen, so I just times it by 36, and that is $14,071.68. Okay? Calculate the amount which must be paid at the start of the lease. Okay, so at the start of the lease, we have to pay the down payment. We have to pay 1 month's payment, which was, what was it again? $349. So $349. And then we had to pay a security deposit of $500, which is a little more than usual. Usually, again, it would only be like $350, but oh, this dealership's more. And that's, I think, it, right? Security deposit, refundable. Yep. Okay, now remember, you get this back when you return it, as long as you didn't go over your kilometers or burn holes in the seats or anything like that. I might need this number again later, so I'm going to store it for now. Put it in memory 1, just in case I need it. So 385.00 plus 349 plus 500 is 39349. 39349. 39,000. Oh, that can't be right. What? Oh, whoops. Yeah, you probably caught my mistake before I did. I put one too many zeros here. That'd be 38. That'd be one heck of a down payment. $38,500. Ugh, why don't I just cross this out? See, this is why I never work in pen. It's $3,850 for a down payment. My apologies, guys. $349 and $500. Boom, that's better. Okay, good thing I saved that other number because I had to erase my calculator now. 3850 plus 349 plus 500. That's more reasonable. $4,699 is how much you have to have ready in cash, saved up to lease this vehicle. Okay? You cannot finance these things for most places unless you put them on your credit card, but I would not recommend that. Think about how much your interest on your credit card is. 20% a month or something crazy? You'd never get out of that debt. So, that would be the amount that you have to pay at the start of the lease. I might need that number later, so I'm going to store it in memory too. There we go. Okay, for the vehicle in example 1, the residual value is 75% after 3 years. Calculate the residual value of the vehicle after 5 years. Or sorry, after 3 years. 3 years. Very few leases would be 5 years. Okay, so 75% of, and this vehicle is worth, that's how good my memory is. What was this vehicle worth again? $34,000, right. So 75% of $34,000. And then include taxes on that. So I'm going to have to take that and times it by 1.12. Because remember, when you buy a new vehicle from a dealership, you pay both taxes, right? Or actually, in this case, it would be a used vehicle, right? Because it would have to count as a used vehicle because it had been a leased vehicle before. So 0.75 times 34,000 times the taxes, 112%, is $28,560. Okay, so for the vehicle in example 1 above, at the end of the 3-year lease, you have the option of returning the vehicle and say, thank you very much, our lease is over, or purchase it for its residual value. Calculate the total price you would pay for the vehicle if you purchased it after the 3-year lease is over. Okay, so this was the purchase price, and I already put tax on it, right? 28,560. And go back. So this is, I'll even write this down. So this is the buyout price. I'd have to pay that. Then don't forget, over the course of the loan, this is my total lease payment. This is how much I paid in all the lease payments, right? So I'm going to need that number. So I paid that, $14,071.68. And don't forget that I had to pay all this up front. Now, I'm not going to include the $500. They'll give me that back. That's refundable when I return the vehicle before I buy it again, right? So, because remember, that was just a deposit. So actually, I could just take that $500 off of here and call that $41.99. So I'm going to just add that there, $41.99. So add $41.99. And let's add all that together. So I already have that first number there, and I saved that in memory 1, didn't I? Plus recall 1, yes I did. Plus $41.99. Okay, and again, let's just write down what these things are again, right? Total payments over 36 months is what that is. And this was down payment plus first month's payment. Now, it is possible that this 36 might actually include the first month's payment, but it doesn't usually. Usually it's like, okay, you pay for your first month and then it's 36 months, 3 years after that. If that had been the case, I'd have just taken this number and subtracted one more month's payment off of that. Okay? This question kind of was vague in the way it described it, so I'm not sure which way it would have gone. I'm happy with this number. If this had been a test question and you would have taken 300 and what is the lease payment again here? 300 and what was it? 349. If you'd have taken 349 off of there and just put the down payment, I'd have marked you right, because to be honest, I can't tell from this writing, from the way this question was written, which one it is. So there's my final answer for how much this vehicle is worth. And as you can see, remember, it was only a $34,000 vehicle new. Now, it was $34,000 plus tax. So let's see. If I had just bought it new, it would have been, let's see, what was it? It was a $34,000 vehicle, right? 34,123 times 1.12. It would have been $38,080 with taxes included. So basically, take this number minus that one. I'm sorry, I erased my other number. Minus $46,830.68. So basically, that lease for 3 years cost me almost $9,000 over 3 years. So that's roughly $3,000 a year just to lease the vehicle. Now, again, what are the advantages of leasing the vehicle? Well, the advantages are, here we go. There's the advantages. Now, remember that if you don't have $38,080 sitting in the bank to buy the vehicle, you would have to, of course, get a car loan to pay for your vehicle. And that's actually what our next lesson is about. It's about how car loans work. So you're probably going, wow, it would have been so much cheaper to just buy the car outright. Well, yeah, if you have cash. Who has this kind of cash in the bank? Most people have to make payments on their vehicle, and what you'll find is that by the time you've paid for the loan on the car, leasing would have been cheaper. And that's actually, I'm just going to go back here. Monthly lease payments usually are actually less. And this is a big one here. I'm kind of out of room. Usually they have lower monthly payments than buying. Now, why is it that they'd be lower? We just calculated that renting seems to be a lot more expensive than buying. Yeah, if you can buy with cash. If you have to finance your vehicle, remember that banks are not a public service. They're there to make money too. And if you're borrowing money from them to buy a vehicle, you are paying them interest. And that interest usually ends up being more than what it would have cost to lease the vehicle every month. So, with that in mind, flip to this one. And let's take a look at these examples here. Okay, Joel wishes to purchase a used car from a dealership for $12,500 after taxes. He decides to get a personal loan from his bank, calculate the total cost to purchase the car. Okay, so I'm going to put a formula up here. I'll say that monthly loan payments, oops, that's an M. Then I'll misspell payments, sorry. Monthly loan payments are the loan amount divided by 1,000 times, yep, just like in the house one, we have a table value. And the table is actually the next page in your booklet. So calculate the total cost to purchase this car first of all. So it's $12,500 after taxes. Okay, so here's, by the way, just to give you a sneak preview, there's the monthly loan payments chart. Make sure that you have that page when you downloaded this notes package. Okay, so calculate the total payments for total cost to purchase the car. Well, the total cost is $12,500 from a dealership. Used cars pay both taxes, so PST and GST. So let's see. So 12,500 times 1.12. Boom. That's $14,000. If he has made a down payment of $27,500, how much of a loan does he need? Well, that'd be $14,000. Did I calculate that? 12,500 times 1.12. Yeah, look at that. Okay, so he's made a down payment of $27,500, so minus $27,500. So he has to borrow, so that's $14,000 minus $27,500. He has to borrow $11,250 from the bank. And here's where we get to use our new formula. The bank is going to offer him a 7.5% over 4 years using the loan payment chart calculated as monthly payment. So 4 years is this column here. 7.5%, so I go down to the 7.5% column. I should say row, sorry, 7.5% row. And 4 years, that's $24,818. So it is $11,250 divided by 1,000 times, and again that number was, that's how good my memory is, $24,818. And then we calculate. So I already have that number there, so I just divide it by 1,000. Even if I didn't have that number, I just move a decimal over, right? Times $24,818, and that is a monthly payment of $272.03. Okay, so calculate the total paid for the loan. It's a 4-year loan, 4 years times 12 months in a year and times $272.03. So let's see. 4 times 12 times 272.03 is $13,057.44, and calculate the finance charge for the loan. So he actually only borrowed $11,250, so it'd be this number. Here's how much the bank is actually making off of him, right? Remember, banks aren't there. They're not a public service. They're businesses, and they're there to make money. And here's how much money they made off of this guy. $13,057.44 minus the $11,250 that he actually borrowed to buy the car that was a $1,807.44 loan. And then for F, calculate the total cost of the car including his down payment. So this is how much he paid, $13,057.44. So that's all the payments, right? And then he made a down payment of $2,750, right? So decimal 00, 5027, right? So add those two things together. So $13,057.44 plus $2,750. And there we go. So he paid, by the time it was all said and done, $15,807.44. Okay? Now, that was for a used car. He ended up paying that for a car that was only worth this. For new cars, it's even kind of more extreme. So, remember that borrowing money costs money, even to do something like buy a car. So that's it for examples. You can now do assignments 8 and 9 from your assignment booklet. I won't assign all the questions. Go to my blog and it'll show you which questions I want you to do. And that's basically it for this unit. We'll have a little test on that, and it'll be really easy. I'm just going to make it multiple choice so you can do it on Edsby. And that'll be it. That's the course. Thanks, everybody.